What's up everyone, my name is Joris, welcome back. Happy belated Tax Freedom Day everyone. Somewhere around the middle of July, us Belgians has finally paid off all our taxes for the year and now we can start working for ourselves. With Austria and France following closely behind, we are the three last European countries to have paid off all our taxes. Taxes. The word alone feels like a curse. An obligated payment to our country so the government can spend the money back into the economy and ideally make our lives easier and overall better. It feels like we're paying a lot of money and next to nothing gets done. Tax money is used on a variety of things, one of which is the wages of our politicians, so it is debatable if the taxes are spent well. By the end of this video, you'll see where our taxes are going and why they are so high here in Belgium. Does paying taxes make any difference? We'll see. But you can start making a difference yourself already by smashing the like button for the YouTube algorithm and by subscribing to the channel if you've not done that already. No one likes to pay taxes, but taxes are needed to support our pensions, our education, our healthcare and so on. Let's look into the different parts of the pie. If you were to pay 100 euros in tax money, 20 euros and 10 cents will go right into the pensions. 14 euros and 20 cents will go into healthcare. 11 euros and 90 cents go to education. 11 euros and 90 cents go back into the economy and the supporting services. 9.3 euros go into the administration of our government. 6.5 euros goes to illnesses, leave from work and so on. 6.2 goes to subsidies to big companies in our country. 5.6 go to the costs of interest. Mobility, 4.8 euros and so on. Often our taxes are frowned upon. Belgium has one of the highest tax brackets in Europe and we hold our top 5 position of European countries with the highest taxes without any problem. During the year, we pay an average of 50 to 55% in taxes on our income, and that's very high compared to the other European countries. But due to a tax shift a few years ago, the overall taxes were reduced a little bit. Our Belgian employees received more net income from their paycheck and less taxes to be paid. Hooray! In 2013, our taxes were an all-time high. That means that our employer had to pay 2.34 euros for every 1 euro we take at home at the end of the day. After the tax shift in 2019, this cost was reduced to 2.01 euros per 1 euro net take home. An average wage of 2,250 euros net per month, so 27,000 euros yearly, accounts for a total cost of 58,000 euros yearly for our employer. So no wonder we despise the fact that we are taxed so much. More than half of our wages goes right to taxes. Tax Freedom Day is a clever way to show how long you need to work to pay off all your taxes. The middle of July accounts for around 55% of the year. So after this date, all earnings are your own. Other countries have way lower tax brackets, so their Tax Freedom Day is a lot earlier in the year. In America, for example, this is around the middle of April. Belgium is one of the last ones in line. But why is there such a difference in tax brackets? Well, there are also a lot of differences in benefits too. Even though we have very high taxes, we do have a lot of social security in Belgium. Since we pay taxes for our healthcare and our education, we can enjoy cheap healthcare when needed. If we're sick or if we need surgery, we often do not pay a single euro at all. Everything is covered by our insurances and the government support to our healthcare system. The same goes for education. I remember paying around 2,000 euros all in yearly in the university. A lot is subsidized by the government or in the end by ourselves via the taxes. Other countries that have their tax system set up differently may be known for quite a costly healthcare and education. You could argue that having higher taxes is some sort of socialistic system, and it partially is. Even families without children will have to pay taxes that will partly be invested in education. You could further argue that lower tax countries are more interesting if you do not have any children or if you do not need healthcare. But unfortunately, it's some sort of an all-in package. You have no choice where the taxes are invested in. As we saw earlier, the biggest part of our tax payments goes to the pensions of the elder generation. On average, people tend to grow older these days, life expectancy rises. Back when pensions were introduced, the average life expectancy was around 65 to 70 years old. Now, we easily live over 80 years of age, but our retirement age has risen only to a mere 67 years old. How is this maintainable in the future? If we pay around 50% in taxes on our income and 20% of those taxes go to pensions, that means that 10% of our wages go directly to the pensions of our previous generation. With only around 1.5 active workers for every retiree, this system is not maintainable for very long. An average working life is 40 years, so from 25 to 65 on average. And if people live until they are 85, they'll get a pension for 20 years, while only have worked 40. That is not comparable. That's why I personally believe that I will not receive a state pension when I'm 65, or 70 by the time that I can finally retire. This is exactly why I want to build my own pension and disregard the state pension. FIRE might be more important than ever. Having income streams apart from the one you're hoping to get from the state will be a major relief and ease of mind when you are older. So do not forget to start building your pension as soon as you can. Of course, let's not panic. Pensions will not be discarded immediately. Changes will come, but an abolishment of the pensions is next to impossible. The government simply cannot tell their inhabitants that they will not receive a pension when they retire after having worked a whole life paying someone else's pension. Choices will have to be made. It will be interesting in the future. I have told you before, and I will tell you again, make sure you are saving and investing for your own future, and do not assume you'll get a pension, because things might change drastically in the future. Maybe not tomorrow, maybe not even in our lifetimes, but things will change. The Belgian pension is divided in 4 pillars. The first pillar being the state pension. The amount you receive every month depends on how much you have earned in the last few years of employment, the number of years you have been employed, the length of your career, and if you were an employee or if you were self-employed. You are eligible for this pension at 65 years of age, but note that this pension alone will not suffice in your daily needs. That's why the second pillar came into existence. This is the pension you are building while being employed or self-employed, and the contributions to this pension are done automatically by your employer, or in case you are self-employed, you'll have to save in a savings plan yourself. Contact your accountant to set this up. This amount will be added to your state pension when you reach the age of 65. The third pension pillar is the one you can do yourself, your personal pension savings, with tax reductions on the amounts you are saving. There's 2 parts of this: the normal pension saving and the long-term pension saving. Pension saving is capped out at 990 euros a year, and you'll get a tax reduction of 30% on the amount you save. You can also choose for the 1,280 option, but it only will give you 25% tax reduction. It's also less interesting in the long run. The long-term savings is capped at 2,390 euros, but your personal max is calculated via your yearly income. Your bank or accountant will be able to calculate this for you. The fourth and last pillar is your own personal savings. This pillar is often forgotten, but it's the most important one of all. There is no tax reduction on this pillar, it's just your own savings. This pillar includes your real estate, your investments, and all other possessions that you can use later in life or that you could sell to live off of. You are going to need to invest in all 4 pillars to get the retirement you want. There is nothing worse than becoming 65 years of age and realizing you'll not have enough money to live the life you want to live. You cannot really compare your financial life while being retired to the life you are living while working. You'll have a lot more time once you are retired. You'll want to travel more and you want to go out more. You want to do all the things you have always wanted to do, and now you can, since you will actually have the time to do so. But do note that all this will cost you money, and your monthly budget might be a lot more than it was in the last few years of your employment career. So please, make sure you have enough money saved up. Or better yet, be sure to have the right investments, to have multiple sources of income that completely cover all your expenses while you're retired, so you can do whatever you want without your net worth dropping like a stone. If you want more information about how to save in these different pillars, watch my video here. If you have enjoyed this video and it has helped you, please leave a like for the YouTube algorithm and consider subscribing to help the channel. It's free, so it's easy to do. Together, we will make sure your financial journey is a successful one. I thank you for watching, and I will see you in the next one.